This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to Fintech Recap. My name is Alex Johnson. I am the creator of Fintech Takes, and I am joined by European man of mystery. We never know where he is, except he's in an electric car, zipping around, avoiding traffic, avoiding the Paris Olympics if he can. Mr. Jason Mikula, publisher of Fintech Business Weekly. Jason, great to see you.
Great to see you. Yeah, I got back from an undisclosed location in the United States. If there was a process server looking for me, he or she did not find me. And we are visiting some friends just south of the Loire Valley, and it is very hot. I feel bad for any Olympians or spectators for that matter, because it is toasty.
I don't envy you or them. I mean, you're sort of our fintech Olympian, so I'm glad that you're representing us at the Olympics this year. Have you gotten a chance to watch any of the Olympics? I know sports as a general category is not one that you dip into often, but it's the Olympics, man. It's every 4 years. They're in your backyard right now.
That is true. And actually, one of my professors in graduate school, his entire area of study, I'm going to botch this, but it's something like the intersection of like the Olympics and so like the economic development or economic impact of the cities that hosted them.
Yeah.
Because you always get these like inflated claims of like, oh, if Chicago hosts the Olympics, we're going to generate $20 billion.
Yeah.
And basically, generally it's a net loss unless the countries are spending money on infrastructure that will be usable and productive outside of the Olympics, which generally is not what happens. I did watch the part of the opening ceremony, the boat parade, and then some of the crazy, like decapitated Marie Antoinette musical performance, which I guess is appropriate since I'm here now.
Yeah, absolutely. Got to get into the zone. I have this theory about the Olympics that they should really only do like 6 cities that can actually do it at scale and not totally destroy their local economy, and just rotate it between those 6 cities. Like, let's not try to experiment with it. The Olympics are going to be in Memphis, Tennessee this year or whatever. Like, that's insane. Like, let's just keep it to LA, Tokyo, London, Paris, I guess, and we'll just be happy with that. I never wanted to come anywhere even like close to Montana. We had the Salt Lake City ones, I think in like the 90s, that was the Winter Olympics. And that was as close as it ever got. And like, I think even that was too close. So I never wanted to even be anywhere close to where I'm living.
Well, and I don't know if the IOC is as corrupt as FIFA, but I listened to like several documentary podcasts about just how like absurdly corrupt the process to like bid to host it. It's like, I think there was like a summer, I don't know if it's the World Cup. I obviously don't watch football/soccer, but it's like a summer World Cup in, was it Qatar? Where it's just like, this is not the right temperature to be playing soccer.
Yeah, no, it was insanely hot. Yeah, and they're just like, well, this makes sense. We'll put it in this place. And of course, there's money changing hands behind the scenes. Yeah, I try to just turn that part of my brain off and just didn't like root for America. And, we've been doing pretty well so far. So far, everything is good. USA. All right, we're going to channel that sort of patriotism, Mr. Mikula, and we're going to talk about what's been happening in fintech over the last month or so, right?
I was going to say, speaking of high-risk jurisdictions and potential money laundering, there have been rather some interesting stories. And I'm thinking, of Mercury and sort of the extended Synapse Evolve multiverse, which really is where the story is at this point.
This is like one of those spin-off movies where like the main characters aren't in it, but they show up like at the end after the credits. Yes. Okay. So give us the download on Mercury.
But the specific thread I'm following here, is I had done some reporting that basically built on a piece that Michael Rodan at The Information had published earlier this year, specifically looking at some Mercury's, or rather clients of Mercury's use of what are called registered agents or registered agent addresses, which, at least as I understand it, based on my own research, as well as talking to experts in the space, does not count as a specific address you can supply as part of an onboarding KYB process, right? You're supposed to have a physical address where your business is actually located at in, as I understand anyway, in the United States, unless the bank has a risk tolerance saying, okay, we're going to do accounts outside of the United States and we have the appropriate policies, procedures, infrastructure in place to do the necessary KYB. So it's not that using a registered agent in and of itself is not allowed, but rather supplying that address as the address of your business without any other physical location is a red flag. And again, as I understand it, that in and of itself generally would not be understood to meet the criteria for KYB, due diligence, etc. It's interesting because in conjunction with what Michael had reported on, now because of the Evolve Russia hack, we actually have access to very specific examples of that. And so I was able to take a look at some of the accounts, Mercury accounts, and the addresses they listed. And you see, literally thousands and thousands of accounts listing the same addresses in Wyoming, which is kind of the US's version of an offshore as far as, corporate secrecy and whatnot, as well as Delaware.
Wyoming is definitely like an island in the middle of the ocean that you never want to try to drive to or get to. It's insane. So that makes sense.
As well as Delaware, which of course is a very common place to set up, incorporate companies for a variety of reasons. And through the course of doing some additional research with current former employees of Synapse, of bank partners, Mercury, it really painted a picture of Mercury specifically taking a very aggressive posture as far as leaning into this as a way to grow accounts, grow deposits, grow transaction volume. Even, and this I know is shocking, even to the point where, from the sources I spoke with, Synapse pushing back, or employees at Synapse pushing back on some of their requests, and Mercury escalating those to Evolve, specifically as it related to, quote unquote, whitelisting certain accounts or certain jurisdictions, including, where perhaps the law had changed after an account had been opened. So, for example, Russia post the invasion of Ukraine or certain regions within Ukraine. So this, and frankly, no idea if this timing was coincidental or not. The week following that publication of that story, Mercury began closing an unknown but significant number of accounts, including in higher risk jurisdictions like Ukraine and like regions in Africa. Nigeria specifically came up a lot. There's a couple of different facets of this story that I'm sure we'll talk through. One of them was sort of the communications piece.
Yeah.
Mercury's founder, CEO, Ahmad, is quite known for being very online, very responsive on Twitter, responding to customer requests for features, customer complaints, what have you. And this was kind of rolled out quietly with emails to customers, including a help page that apparently was just factually wrong, which raised a lot of concern because it said, founders or UBOs of companies that hold certain passports, including a Ukrainian passport, even if you do not live in those regions, if that is the passport you hold, we're going to close your account. And then they had to backpedal and say like, oops, that was wrong. So there have been like some interesting hot takes on this. I know you wrote about it. I think
I did.
Our friend and industry colleague Simon Taylor wrote about it. As far as sort of, I think everyone can agree, this is a terrible situation for companies, for founders who came to depend on this service and then have something like, I think it was 3 business weeks, like 15 business days to find a new solution. I think everyone can agree it's bad for them. Totally. And then the question is like, how did this happen? Who's to blame? Why is this happening? And there do seem to be quite a number of different points of view on that. I'm curious, since you wrote about it, I'm curious to hear sort of how you thought about that and sort of parsed, why did this happen? What's the fallout? And go from there.
Yeah, absolutely. I think that there is definitely nuance to this topic, right? Because I have spoken to a number of fintech founders over the year, I'm sure you have as well, where they'll be working with a partner bank and they'll be trying to build their product, trying to grow their business in a way that is, as they understand it, sort of consistent with all of the regulations and compliance requirements that you have working in financial services. And obviously, some of the founders that are building in fintech, in fact, a lot of them probably haven't worked in financial services before. And so that understanding might not be 100% accurate. They might not, especially early on, engage the services of very experienced lawyers who can guide them through some of those things. So there are some small mistakes that get made. But a lot of times, I've definitely heard of examples of the fintech not really doing anything super egregious. And then what happens is, for some larger macro reason, something changes with the bank partner, and the bank partner suddenly is de-risking in some fashion. And that de-risking can be requiring the fintech company to close accounts, as we've just been talking about. It can actually be the bank partner just getting out of the space entirely. I remember this happened with Radius Bank, based out of Boston, when they were purchased by Lending Club. This was a good example. They were doing a lot of banking as a service, and there were fintech founders who were building on Radius who I've spoken to, who basically just got a notification that, hey, we're not doing this anymore, and you're going to have to not be our partner anymore. And that left them in a really difficult position. A lot of them weren't able to find another bank partner. They had to close down. So I'm definitely sympathetic to situations where fintech founders are trying to build things in the right way, and the rock rolls down the hill from regulators or from the bank, and it just ends up kind of wiping out their business, sort of as a side effect of some larger decision that's made. So I totally get that. That's not what happened here, from everything I can tell. And again, this is just based on reporting from you, reporting from the information, some other sources I've spoken to separate from your reporting. Nothing about this story suggests that that's what happened here. The read I have on the Mercury situation specifically is, and using the examples you gave in some of your reporting just as a specific point here, Mercury had a pretty good understanding of what the requirements were in terms of compliance requirements, in terms of processing transactions going from certain geographies, in terms of onboarding customers and the information that you're required to collect there. And my understanding and my sort of sense of the situation is, whenever those compliance requirements conflicted with the goals that Mercury had as it relates to growth, or as it relates to trying to provide a frictionless experience either to new customers who are onboarding or to existing customers where you don't want to stop transactions or slow them down or really put anything in the way of them transacting on your platform, they basically sought out ways to get around that. And Evolve, as we now know, was the perfect bank partner to partner with if that is your goal. And I've written about the fact that Evolve's sort of incompetence as it relates to being a bank was really a feature, seemingly, for a lot of the fintech companies, not just Mercury, but other fintech companies as well, who chose them as a bank partner. But yeah, I mean, the fact that Synapse was kind of the good guy coming out of that last story that you wrote, that's wild to me, because we've been talking for months about how Synapse has made huge mistakes all over the place as it relates to managing compliance. And they were the ones saying, no, hang on, this might not be what we want to do here. And Mercury is going around them to Evolve to get approval for this. So in this particular case, I am super empathetic towards founders that were working with Mercury who sort of inadvertently got caught up in this de-risking. And I do think that Evolve, reacting to everything that's happened, probably has taken a bit of a broad brush to trying to clean up some of these things. And that has resulted in founders who probably shouldn't be getting offboarded. There's some collateral damage here. And I think the collateral damage is definitely due in large part to Evolve not doing a good job as the bank that's ultimately legally responsible for this stuff. But to position Mercury as sort of a piece of that collateral damage who's just subject to the whims of Evolve, I think that takes a lot of agency away from Mercury and the responsibility that they should have had, and I think knew that they had as they were building all of this over the last couple of years. So that's my maybe overly cynical interpretation. What's your interpretation?
I mean, I feel like we've had some version of this discussion many times on many podcasts.
Yeah.
But about the mismatch in risk tolerance and in priority, right? And obviously today we're talking about Mercury, but this is not, I don't think this is specific to them. I saw it earlier in my own career, and I think there's plenty of other consumer or customer-facing fintechs we could point to that illustrate this.
Yeah.
But if you're unprofitable and you're venture-backed, the goal, at least until maybe fairly recently, was
right.
grow as quickly as possible, right? I spoke with Jason Henricks and with Frank Rotman recently at Unit 21's Fraud Fighters about some of that shift in focus on, I think, what we would now consider vanity metrics, like a user number, an account number, frankly, even top line revenue in certain businesses, especially a lending business, to really looking at, do the unit economics work? Is this a sustainable business? And I think, to your point and some of the points you made, we know that Mercury intentionally pursued this strategy. Yes. So, for example, partnering with some of these companies, one was called LLC University. I'm forgetting the name of the other one. But basically, Mercury had an affiliate relationship where they would pay these essentially like shell company mills to refer new business customers to Mercury. So It's not like, oh no, like this is an accident and we're just, we're naive and we didn't know better. And now the big bad bank came, and slapped us on the wrist and we're going to de-risk. It's like, no, you pursued this intentionally as a growth strategy.
Yes.
Including, at least, based on my sourcing and reporting, pushing back on your, what is our new word, platform intermediary.
Yeah.
And going, to the bank partner to say, yeah, like this is what we want to do. And so I don't, I think it's fair to acknowledge that if you are a non-bank fintech, ultimately you're at the mercy of your bank partners. Yes. And, you should probably build your operating model and your strategy with that in mind. Otherwise, you will get situations like this. And I, this isn't the first sort of example of this, and I doubt it'll be the last.
Yeah, I completely agree with that. I mean, I think in a macro sense, we're really just cleaning up from the last 5 years, right? Because there were just a ton of people who got into fintech because they wanted to attack a problem. And of course, Mercury is a great example of another trend that kind of drives me crazy personally, which is let's build better fintech solutions for tech founders because they're so tragically underserved. And like, we must help this particular group of, consumers and business owners. So that's like another category of sort of fintech bias that bothers me. But regardless of sort of what customer base you're serving, if you got into fintech and this is your first time building in financial services in the last 5 years, you had some really weird incentives, right? And it's actually, in a lot of cases, very likely that you had your investor that you raised money from suggesting to you, hey, if you're trying to get started building this bank, we have this middleware platform that we also invested in that is a great way to get started. And they have these great bank partners who are really easy to work with, and it's fantastic. And like, just build on this, grow. So, I mean, there is a drop of sympathy, I suppose, for fintech founders who come into fintech kind of in the wrong era, so to speak. And everything is about smashing that easy button, getting to growth as quickly as possible, not caring about profitability, optimizing towards those vanity metrics that you mentioned. And now we're going through sort of a cleanup and a de-risking process where a lot of those businesses, including ones that have raised a lot of money, have very high valuations, and I will say this about Mercury, great products. And this is something else I've written about in my newsletter. Like, everything I hear about Mercury's product is like, it's incredible. Like, it's the business bank account of the future. It's fantastic. Like, people love the product. But if the product is tied to a business that was taking these shortcuts, there is going to be some of this collateral damage. And so I suppose if we want to end on a slightly optimistic note, before we get into our next story, then we have to get all pessimistic again. My optimistic note would be that we are, I think, at this exact moment, dealing with maybe a bit of an overreaction from regulators or from banks, but generally we're operating in an environment with the right incentives. And so even though we're going to go through some of this pain, and there is going to be some of that collateral damage, I do think the incentives are right. And what's getting built right now or rebuilt is probably going to be closer to what we're going to want to see sustaining over the long term.
There's one more point I'll add, and then, yes, we can move on. The CEO founder of Mercury, Ahmad, made a post, which of course immediately leaked, about some of the thought behind this decision. And I'm paraphrasing, but it said something along the lines of, these accounts that we are closing, accounted for something like 1% of the deposit volume, but like 50% of our compliance costs.
Right.
And on the one hand, it's like, okay, when you start to talk about things like, everyone's favorite phrase, access and inclusion, that is a very real consideration because, running a financial services company, whether it is a non-bank fintech with a really pretty UX or whether it is a bank, ultimately these are for-profit businesses. And whether it's JP Morgan Chase saying, hey, you know what? We're going to charge pardon my language, a shit ton of overdraft fees, NSF fees, min balance fees, because these low balance customers are not profitable. So either we're going to fee them to make them profitable, or we're going to fee them until they leave. The Mercury situation, obviously, the mechanics are a little bit different, but it's like, oh, well, trying to serve a business customer in a not sanctioned region of Ukraine is very complicated. I actually, frankly, I couldn't even explain what that entails, but I'm sure it's very complicated versus, the actual revenue that account generates. So, I mean, this is an inherent tension of talking about things like access and inclusion, but also making what are rational business decisions. And there is no, to use your phrase, there's no easy button answer to that.
Yeah.
Did I turn it pessimistic again? I'm sorry.
Well, God damn it, Jason. No, I'm just kidding.
Realistic.
Yeah, realism is where we should try to anchor ourselves. No, I totally agree with that. And I just think, with all this stuff, there's a limit to what we can do easily, right? And some of this stuff is just really hard to solve for. And I know this is contrary to the Silicon Valley ethos, but like technology doesn't solve some of these problems, right? Like some of it is just like to your point about dealing with some of these regions that are sort of right in the gray area of sanctions and some of the compliance challenges. It's really hard for anyone to work with them, banks, non-banks, and there's no level of like automation or AI that can really make that any easier. And sometimes certain customer segments are just really expensive to serve. We saw that with Brex when Brex went out and tried to serve small businesses more broadly, and then they kind of like turned tail and ran for the hills and tried to get back to kind of their venture roots. Like some segments of the market are just very, very difficult to serve. This is actually, this focus on realism is actually a pretty good segue to our next story. Can I take you to another, I guess, alternate universe that's sort of spun off of the Synapse Evolve multiverse? Is that okay?
We have just started a new running joke, and I'm not mad about it.
No, I'm not mad about it either. I think Marvel Cinematic Universe as a parallel to Synapse and Evolve, just from a like, oh my God, I'm exhausted, are we still doing this thing, actually makes a lot of sense. So let me bring in another one. I don't know if this is the equivalent to me seeing Deadpool and Wolverine this weekend, but maybe it is. I'll let you decide. All right, so this is a request for information, an RFI, that was put out by the OCC, the Fed, and the FDIC, so the Federal Prudential Banking Regulators in the US. And it's pretty interesting timing, coincidental maybe, because they are asking about bank fintech partnerships. So might have something to do perhaps with Synapse and Evolve. Maybe they do seem to reference in the RFI some sort of recent situations that have happened. Who knows what they're referring to? But the RFI itself is pretty interesting. So I'll give a quick run through of some of the main areas that they hit on. And then, Mr. Mikula, I'd love your take on it. In the RFI, they ask about a lot of different areas, but the ones that jumped out to me, first one was the potential for consumer confusion that can arise from bank fintech partnerships. And the types of questions they're asking about here are things like, how is the relationship between the bank and the fintech company being disclosed and explained to the consumer? Do consumers understand the nature of that relationship? Is saying something like, we're partnered with this bank, FDIC member, does that give the wrong impression to the consumer about the safety of this product and what it's like to interact with it? So consumer confusion, which has come up quite a bit in the wake of the Synapse bankruptcy, that was definitely an area that they asked about. They also asked about operational resilience and planning for worst case scenarios. So they mentioned cybersecurity, maybe not a coincidence given the Evolve data breach. They asked about the process for winding down fintech relationships and exiting them in a orderly manner, and actually the impact of such exits on banks' liquidity and planning for sort of managing their balance sheet. They also asked about, very specifically, reconciliation, and if there are particular account structures between these bank and fintech arrangements. Like, they didn't mention this by name in the question they asked, but FBO accounts was something that they were pretty clearly pointing at. And is that a fit for purpose structure for managing these partnerships and keeping accurate title of the accounts and who owns the different accounts? They asked about intermediate platforms, which you sort of hinted at before. Intermediate platforms are, I guess, the new word that we're using to describe Synapse and Unit and Treasury Prime and essentially any of these BaaS middleware platforms that we've talked about for years now that sit in between banks and fintech companies and help sort of provide that easy button or that ability for them to integrate more sort of efficiently. They ask specifically about what risks are introduced when those intermediate platforms play a more active role in providing managed services and managing things like compliance or reconciliation or other sort of operational tasks. And then finally, the last area that they asked about that I was personally very thrilled to see them sort of articulate in a clear manner was the impact of different business relationships and contractual arrangements on these fintech business arrangements. And this seemed to be clearly sort of aimed at differentiating between standard or traditional bank vendor relationships, which is what a lot of the existing third-party risk management guidance that comes out from the agencies addresses. And that's an arrangement in which 9 times out of 10, the bank as the buyer is going to have at least some leverage or usually more leverage than the vendor who is supplying those services. And so it's a sort of classic supplier versus buyer relationship and the sort of dynamics that are existing there. When you extend that model into bank fintech partnerships, and this was very clearly illustrated in the questions that were being asked about in the RFI, that same dynamic doesn't exist because in a lot of cases, and I've written about this, I know you have as well, fintech companies a lot of times have more leverage in those negotiations than the bank. And functionally, even though this isn't legally how it works functionally and in a business sense, the bank is the supplier and the fintech company is the one shopping for a bank partner. And the agencies were very interested in understanding, well, what are the risks associated with leverage existing more on the fintech side than on the bank side? And what are the impacts to the accountability when something goes wrong if the split in operational responsibilities or contractual responsibilities or even liability is maybe apportioned a little differently than you would expect based on those power dynamics? So really interesting questions kind of across the board that they were asking about. One of the final questions they did ask that I thought was really funny was they're like, would it be helpful, I'm paraphrasing here, would it be helpful if we offered more specific guidance on any of this? And I just wanted to like immediately reply to the RFI and just be like, yes, in all capital letters, like give us more specific guidance. So I do think there is probably something that's going to come out of this, but it might be a little too early to say exactly what that's going to look like. What was your read on this? Did you get a chance to go through the RFI?
I read most of it, not all of it.
He read every word and he has it memorized.
Yeah. No, I mean, starting almost in reverse, the question is, okay, so they're going to collect this information to do what?
Yes.
And I mean, I think, part of that is going to depend on, whether or not current bank regulators are still in their roles, come whatever, early January 2025.
Yes.
Because I have to imagine undertaking this RFI process and then, if it leads into some kind of official like APA rulemaking process is not, it's not a quick undertaking.
No.
And I mean, I know we're going to get to this a little bit later, but it seems like the appetite, particularly from the FDIC, which of course has its own potential leadership change, maybe coming-ish
at
in
some
September,
point, maybe. Yeah.
But certainly, the current leadership at FDIC and, at CFPB, which, wouldn't, as I understand it, have any direct role. I'm sure these guys have a WhatsApp group, though.
Well, we saw them all in a hearing yesterday, which we're going to talk about a little later. They were all together up on stage, yeah.
The Synapse disaster, and it is a disaster, I think has really catalyzed what was already sort of a brewing storm. I'm mixing all my metaphors now, but it's like, we'd already seen this string of enforcement actions, including touching on many of the topics that you mentioned, things like business continuity, things like having a wind down plan in place, including, the customer facing side, but also, for example, Evolve's enforcement action requires it to get its regulators' permission to offboard a fintech program due to potential risks to liquidity. So to string together all our stories today, it's like, imagine Mercury has billions of dollars in deposits and your balance sheet as a bank is dependent on those deposits. If for whatever reason those are going away, but you've deployed those liabilities into assets that are either longer term or underwater due to interest rate risk or whatever, like you're going to have a liquidity problem. And so I do think the RFI, really builds on and makes very explicit the themes we've seen in, the dozen or so enforcement actions, the Blue Ridge and Thread and Choice Bank, and all the other ones, and says, hey, okay, like we've been messaging this to the market in a certain way, like this is a mechanism to basically like provide input and feedback, obviously from the banks, but perhaps even more importantly, from the fintech side, who often don't have a direct line of communication or a direct, supervisory relationship with these regulatory agencies. Not that there are zero conversations, certainly there are, but I think they have a bit of a different flavor given there is generally no sort of official regulatory relationship. And then, the question I'm most interested in, and I'm sure we could find, you guys should find an expert for Bank Nerd Corner to ask the question, what typically happens as an output from an RFI? Okay, so you're going to gather all this information, presumably produce some kind of report, and then, presumably they're going to do something with it. Now, is that some kind of like non-binding guidance? And we've seen a bunch of that, the third-party risk management, the due diligence guide for community banks wanting to engage with fintechs. Is it going to be like a non-binding guidance document? Or is it going to be like an actual, APA rulemaking undertaking? And frankly, it's just so far outside my realm of expertise that I don't even want to venture a guess.
Well, I think to your point, the interesting thing will be there's multiple mechanisms, and you've written about a bunch of these in your newsletter, that federal regulators could take to address some of these things. And so I do think it makes sense, even though this is going to be a slow process, for them to ask about all these areas. And I do give the agencies credit, like they hit all the hot button issues. Like when I was reading through the RFI, there wasn't anything glaringly missing from my perspective in terms of like, oh, you forgot to ask about whatever. Like they touched on a lot of areas. They did it much more specifically than I've ever seen them do before. None of that non-binding guidance that you mentioned before even really kind of indirectly touches on some of this stuff. And so like, this is by far the most dialed in I have seen the agencies talking about these issues and sort of how to address them. So I think it will result, I hope, depending on, I guess, the input they get, in a pretty rich collection of information about discussions on the risks, and they'll be able to form some good opinions about that. What it results in, though, is, as you say, very open. I don't know exactly what it's going to be. If I had to venture a guess, I would say it probably results in multiple different things. One of the things I always am kind of confused about with the agencies is when they choose to cooperate and when they don't. And so, harmonizing interagency non-binding guidance is one thing. And I do think, if I had to venture a guess, we probably will see updates to third-party risk management guidance, just as one output of this would be, I think, a reasonable guess. I personally think they should sort of have bifurcated guidance between this is how you work with vendors when they're actually vendors, and this is how you work with companies that might be treating you as a vendor. Like maybe having two separate sort of sets of guidance might make a little bit of sense there. But then, does it result in formal rulemaking? Does it result in the agencies picking up our favorite tool, the BSCA, and maybe getting a little more actively engaged in working with some of these intermediate platforms that they were mentioning before? There's a lot of different, I think, legal avenues they could explore, but how much they do that, and then of course like how prescriptive they get, right, is the other thing with all of this. I mean, I don't really get the sense, and you talk to lawyers, you talk to folks who've worked in regulatory circles for a long time. Regulators don't like to be prescriptive because as soon as they give you like a rule, you find a way around it. Like you pay lawyers an obscene amount of money to find loopholes to get around things. So you want to try to be vague if you're a regulator. You want to be more regulating in some sense by enforcement than by really prescriptive rules. And so I do think that's going to be an element to this. I also think the other thing that factors in here is the sort of larger legal changes around the end of the Chevron doctrine and sort of courts not giving as much deference to regulators. That probably also impacts this, right? Like, why do I want to come up with a really prescriptive set of rules if those rules might be a novel interpretation of existing statutes or laws that I can get sued over and the courts will toss out because they're not giving me deference to write new rules anymore? And so the push and pull between that, maybe if this goes back to Congress, I mean, you've talked a little bit in your newsletter about sort of congressional testimony or questions that are being asked of federal regulators when Jerome Powell goes and testifies before Congress. I mean, it's going to end up in someone's lap, but to your point, I don't know that we know exactly what that's going to look like. Can I ask you a specific question?
Sure.
Because there was something that I mentioned before and that they talked about in the RFI that I don't quite understand what's going to happen here. How do you clear up consumer confusion about all of this? Like, I'm glad they asked about that, but what's the solve there?
I mean,
Fix this problem for us, Jason, please.
I will do this in the next 60 seconds. No, I mean, the default reaction in the American, really any system, including the financial system, tends to be to default to a sort of informed consent disclosure-based regime, right? And so you get things like the TILA box, Schumer box. In a completely different example, if you go, pick up a prescription at the pharmacy, you get a 7,000-page booklet about how many different ways it will kill you.
Super useful.
Yeah, very helpful. Everyone reads that at CVS. I mean, my gut, and we've already seen this, from state regulators, specifically California, but also Illinois in regards to Chime, is the sort of like de facto language. It's like, okay, maybe you don't say that you're a bank, or like say you're a bank, but immediately below that in a much smaller font, say, we are not a bank. We are a financial technology company, banking services provided by Bank X, FDIC. The reality, and I think I think most people would agree with this. It's like, I don't think that's going to make any difference. If there's something that I've taken away from, especially the Synapse case, and Yada is the one that comes up most frequently, but I think it's true of many of the companies that partner with Synapse, is people and end users, thought of these companies as banks, often including specifically looking for that FDIC symbol or language, because they have been taught to think that FDIC equals my money is safe and I will get it back. And as we've talked about ad nauseum, that's not exactly what deposit insurance does. And so I don't think there's any easy way from a disclosure perspective to explain to an average consumer that if you're using a product, whether it's Yada or Juno or Chime, like this company, and to be clear, I don't know anything about Chime. I'm just using it as a well-known example. It's like this company, this application you're downloading is not a bank. It is basically a service to help you open an account, in Chime's case, at Bancorp and or Stride, depending on the product, and basically service that account. Yeah. And what risks go along with using something like Chime instead of, I'll make somebody else very happy, instead of Vero, which is a bank and actually has a charter, and not that Vero doesn't rely on third-party service providers, right? It has a core banking provider, Temenos. It, I'm sure, has some sort of issuer processor to handle debit transactions. So there is no way I can imagine where you could sort of boil down the immense amount of complexity and make it intelligible to a end user of like, what is the risk you're taking from using Chime instead of using Vero. I can't even explain it clearly, obviously.
No, I mean it's exactly right though. I mean, I think like this is the problem for Chime, right? In a nutshell, is that like, and I think you'd agree with this. Like, Chime is very big. They are very well run. Like, the people who are at the helm are very experienced at doing this. They have, I think, from everything I understand about them, a lot of the controls and contingency plans and operational resilience, like the stuff we've been talking about that you want to see from all fintech companies. I think Chime is a pretty good example of a company that's doing all of that. However, just strictly from a consumer perspective, if you're like, I got burned by this Synapse, pick on one of the companies like Yada thing. Like, I got burned by this. I don't want to experience that ever again. Technically, Chime is in the same bucket as Yada. Now, again, they're very different, I think, in terms of how they're run, the scale at which they operate, the sort of inherent protections built into it. If I was recommending, different banking services to people in my personal life, I think I have in the past recommended Chime for certain people. Like, I have a lot of confidence in Chime in terms of how they run the ship. However, I can't look someone in the eye and go, can you guarantee me 100% that what happened with Yada couldn't happen with Chime? And the problem is, absent that FDIC sort of safety net that sits at the bottom of chartered banks, I can't, right? Like, I mean, there is some alternate universe in which the people at Chime go crazy and just decide to run off to the Bahamas with your money. And like, yeah, that's going to go into a bankruptcy process. There might be things that eventually result in you getting your money back, much like what's happening with Synapse. But there isn't going to be some orderly process to make sure that on Monday you get access to your money. That's not how that works. And it's the same with PayPal. It's the same with, name whatever large non-bank provider people trust. That trust sits on top of their history of doing the right thing. It doesn't sit on a safety net that really ultimately would save you in that example. And, there's been a paper that has been going around from Dan Ari that everyone's been reading and referencing lately. We had him on the Bank Nerd Corner podcast. And in that paper, he references, MoneyGram as an example of a financial services company that was licensed at a state level. So they had these state money transmitter licenses. And, those money transmitter licenses had certain requirements on a state-by-state basis in terms of what those companies are allowed to do with the money that they're holding on behalf of customers that's sort of staying in their own little ecosystem, which obviously PayPal and a lot of other companies that have money transmitter licenses, they have a similar business model where a lot of money sort of sits in their coffers. There are restrictions on what you can do with it, but the example that Dan shared in the paper that was alarming to me when I heard it was MoneyGram stored a lot of that in mortgage-backed securities, which was not restricted at the time, at least, by a lot of the licenses that they held. But this was right up to the lead up in 2008 when mortgage-backed securities crashed. And suddenly they had a huge hole in their balance sheet that they had to fill. And they were this close to filing for bankruptcy and putting a lot of their customers' money in jeopardy and not being able to easily get it back out. And so it's not like these things don't happen from time to time. And, I think the thing that was nice about Dan's paper is he was just pointing out, if the worst case version of all of this happens, and it did happen with Synapse, absent you having that FDIC protection that directly applies to you, not to the partners you're working with, there is no safety net, and how you communicate that to customers is really tough. So what do we do in terms of addressing consumer confusion? I mean, I think this is a huge issue for the FDIC. And I do think it's interesting that they're one of the agencies that's putting this RFI together. So I'll be very curious to see how the FDIC specifically engages with this question. And then, more broadly for the industry, for fintech, if I'm someone like a Chime, I'm thinking really strongly about like, can we create some type of industry certification? Can we regulate ourselves to some degree? Like, how can I create a badge that consumers understand and trust that can be on my website, but isn't necessarily going to be on the website of all of these other sort of, call them lower grade versions of what I do that maybe consumers shouldn't trust yet? Like, we have to come up with some kind of solution because this is a problem.
The frame, and I guess we're all just in the Dan fan club now.
We are.
I am. The point that he made in regards like to the MTLs and how that money is invested, or using the point he was using that to illustrate, is this idea that not all money, or not everything that we think of as money, is necessarily actually the same. And he gives a lot of the sort of back history, wildcat banking, blah, 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 blah. But I think, I mean, to try to sort of, draw that through to what we're talking about now, it's like, well, is having $1 in Yada, which is maybe somewhere in the Synapse multiverse, the same thing as having $1 at Chime if that dollar is just sitting at Bancorp? And, that I think is a sort of very like nerdy intellectual lens of the discussion we're having. And then the question is like, how do you sort of push back on this growing divergence that Dan explains in his excellent paper of like, well, this is a problem. Like if we're using these sort of state MTLs and sort of the safety, soundness, how the funds are being invested, how as an end consumer, the extent to which I'm protected and will get that money back or not, it risks undermining sort of faith in the financial system and in currency broadly. So now that we've solved that problem, do you want to take us to our next burning piece of interpretive guidance?
I do. Yeah. Speaking of like, what are regulators going to do? And is it going to hold up if they do it in the right way? Listeners probably are familiar now with the CFPB's proposed interpretive rule around earned wage access, which came out, now a couple weeks ago, I guess. And this was something that everyone knew was going to happen. This was like the shoe to drop in the fintech land that everyone knew was going to happen. And I've joked that like they knew they were going to be unhappy. They just weren't quite exactly sure why they were going to be unhappy, but they knew they were going to be unhappy. And indeed they are, because in sort of an apparent reversal of the guidance that the CFPB gave in 2020, which was sort of a different CFPB, obviously, this interpretive guidance basically clarifies that EWA products are credit, and as a credit product are subject to the requirements of the Truth in Lending Act, or TILA, which we've already referenced, and the implementing regulation, which is Reg Z. What's interesting is it would interpret sort of a finance charge, quote unquote, to any of the kind of main ways in which EWA providers monetize their service. That includes asking for voluntary tips, which I've ranted about in a completely unhinged way in my newsletter and in this podcast before. But it also includes things like expedited delivery fees that are sometimes offered by either employer-sponsored EWA providers, so an EWA provider that's integrated with an employee's employer and is sort of offered through that channel, or direct-to-consumer EWA providers, where this expedited delivery fee essentially takes the delay out of a standard ACH transaction and gets you your money instantaneously in exchange for, a fee that ranges, I think, Jason, between like $2 to like $5, $6, $7, something in that kind of general range. Based on this interpretive guidance, borrowers must receive disclosures as to the cost of these loans, which is how the CFPB is considering them. Now, there are some interesting nuances here. For example, as smart lawyers on LinkedIn have been pointing out, APR requirements don't necessarily apply to closed-end credit if the amount of the finance charge is, for example, below $5 on a transaction of less than $75. And so in certain circumstances, disclosing that APR, which doesn't look great in a small dollar lending context when you're paying, 120% APR, 290% APR, you don't necessarily have to make that sort of uncomfortable disclosure if the transactions are below a certain amount and the fee is below a certain amount. So it seems likely that this interpretive guidance, at least on that front, will hit employer-sponsored EWA programs a little less so than it might hit direct-to-consumer EWA programs. Obviously, tips is its own whole ball of wax, where the sort of variable nature of tips, it's a little unclear to me how that's going to be applied as a finance charge and for disclosures for the purposes of this. But given that the CFPB, I think, shares my belief that tips in fintech are bullshit, I think the guidance is sort of designed to discourage the use of tipping to the extent that they can. And, I think the other thing that's interesting here is that, again, my understanding of the way the interpretive rule is sort of being framed here is that it would potentially trigger state usury cap limits. And that in some ways is the bigger issue, because if you are a EWA provider that has not been doing this through a partnership with a national bank, that's able to preempt state usury cap limits, you might end up being in some trouble here because your loans that you're now offering that you've tried to position as not loans, they're non-recourse, we're not charging a required fee, all of these sort of tricky ways you've been trying to get around that, that may no longer be permissible from the purposes of this interpretive rule. Therefore, the state usury caps might apply. Therefore, and this is kind of my theory, Mr. Mikula, we might see a shift in EWA more towards a bank-sponsored model, which is interesting because there are definitely providers in this space that already have more of a bank-sponsored type of model. I mean, the example I keep coming back to is Chime, which has made some recent investments in earned wage access. They've launched their own earned wage access product, which does not charge tips. They've also bought Salt Labs, which is sort of an employer benefit platform that was started by Jason Lee, who has sort of a history working in the earned wage access space. So Chime is clearly like betting on this as a product category, but because they're partnered with banks, they probably will have less of the sort of challenges than one of these non-bank providers that has sort of been trying to treat earned wage access as a non-credit product. So the question, of course, is if this rule actually goes into effect, and I think it's a foregone conclusion that the CFPB is going to get sued over this, probably by multiple different parties, if I had to guess. Obviously, the fact that the Chevron doctrine has been overturned and courts are going to pay less deference to sort of novel interpretations means that I think the CFPB's proposed rule here is a little less likely to be held up. And then, of course, the fact that this is a interpretive rule rather than going through the formal rulemaking process. I wrote about in my newsletter the fact that I think the CFPB is kind of trying to rush through a lot of these things and get as much done here as they possibly can. The fact that they're taking the interpretive rule guidance, which is really supposed to be used for interpreting sort of existing statutes, laws, regulations, that also might make this subject to a little bit maybe easier to overturn. So I don't know. I mean, I know you've been poring over this stuff and people's analysis of it. What's your interpretation of the interpretive rule?
I like that. My interpretation of the interpretive rule. Yeah, I mean, not surprisingly, the two trade groups that are most well known for representing fintechs, AFC and FTA, were not pleased with the rule. I will say I'm not, as much as I mainline American politics, not my specialty. I would think, as far as sort of like the advocacy piece of this or the lobbying piece of this, I do think just from like an optics standpoint, if it were me, I think it's a lot easier to make the argument that either, employer integrated earned wage access, and or direct to consumer where it is free or very, very close to free. So I was actually, while you were talking, in addition to listening, I was looking at the Chime's product, which they call MyPay. And it can be free, or if you want it instantly, I think it's like a flat $2 fee.
So they have that expedited delivery fee.
Yes, and it is bank integrated. So technically it's being provided by, I think, Bancorp, right? I think it's worth pointing out that this stuff is not free to offer.
No, not at all.
It depends on, it gets quite convoluted because there are a lot of sort of different operating models and revenue models. If you have a non-bank EWA type product, there are at least two major costs. One is the debt capital, right? So
yes.
Yeah,
you are lending money. You're advancing money.
Well, no, don't use that word.
You're giving them early access to money they already have. It's definitely not a loan. Of course. Sorry.
I mean, even if you're employer integrated, the default risk should be, if not zero, very, very, very close to zero, right? So,
yes.
If I'll use daily pay as an example. If your daily pay, absent some weird, edge case, you're almost certainly going to get that money back when that person's payroll runs. However, debt capital isn't free. I mean, maybe 3 years ago, it was closer to free.
Well, and it will be cheap because your default rate is low, right, based on your model. So it's not as expensive as other types of lending products, but lending products, non-lending products. If you're doing unsecured lending, to do like credit card debt repayment, your debt capital is going to be a lot more expensive, but they're still going to charge you to get that money, to your point.
Yeah, I mean, it's the opportunity cost of the private credit fund who's providing that capital. So if they can go park it somewhere else and make 5%, they're not going to give it to you at 3%, right? So it's not free. And then the second piece is, despite the launch of things like Clearinghouse RTP and FedNow, instant funding also isn't free, particularly the rails that these providers tend to use, which it varies, but it might be something like Visa Direct that is taking advantage of debit rails, and that there is a cost to that, right?
Yeah.
So even if you were trying to do this at break even as a charity, charging $2 or $3 or $4 or $5, I haven't run the numbers, but I'm guessing that that's probably what it really costs to offer this service as a standalone company. I do think it's interesting. And I think there's a wider story here about the role of fintech in driving innovation that does not occur inside the bank regulatory perimeter. I do think that there is an argument to be made that banks are actually better positioned to offer this product due to their lower cost of capital. And again, from very quickly scanning the Chime page, which appears to be like a DTC product, the ability to sort of be first in line for repayment if somebody's getting their direct deposit into that account. I mean, again, there's sort of a continuum here from classic payday loan, the world I came from, through employer integrated EWA. And there's a risk continuum and then different operating models that go along with that. And then the question I always ask is which of these would you prefer as a regulator, as a consumer advocate? Which would you prefer people be using? And we tend to spend all this time focused on the supply side. And understandably, there's not a ton that OCC or CFPB can do about how much somebody's getting paid, but very little time talking about the demand side. Although I have to give credit to OCC for trying to push some, financial health metrics. It's okay, classic payday loan average is $10 to $15 per 100 borrowed. If you're using an EWA that is $0 or $2 or $4, for a similar advance, sure, on an APR basis, it might still be 100%, but it's inarguably better than a classic bank overdraft, at least before the policy shifts we've seen in the last couple of years, and a classic payday loan. So it's I understand why there's some agita from consumer advocacy groups, from certain corners of the regulatory world, particularly, again, because looking at the sort of continuum of products, some of them are kind of shady. If you're using dark patterns to trick people into giving tips, and then you're, not disclosing that as a finance charge, and really it's 600% APR, which we've seen with companies like Solo Funds, we've seen with companies like Dave. I can see why there's a need to try to provide some clarity here. I don't know. Did you ask me a question? And if so, did I answer it?
I asked you to provide your interpretation, and that was a hell of an interpretation. No, I just building on 2 points you made. One is, I kind of think, and this is a thing we talk about a lot. It's a thing I talk about with Simon on Not Fintech Investment Advice, standalone company or feature of a company that already exists. And when I look at earned wage access, I just don't see enough margin available if you are doing this direct to consumer by yourself, not as a bank, right? I just it's really hard. And I think you illustrated it really well. Just to break even, you kind of have to do some version of what you're doing. And what's funny about this, and funny and sort of tragic in a way, is you have consumer advocates who are on a state-by-state level and on a federal level basically saying any innovation in lending is just payday lending wearing a new disguise. It must be stopped at all costs. And on the other hand, you have fintech companies that are trying to innovate on the lending side. And, some of them are bad actors, some of them are good actors, right? Some of them do things that really absolutely need to get shut down immediately. But the problem is a lot of consumer advocates, for reasons I understand, don't really want to draw those distinctions. They don't want to be nuanced about it. They just want to stop any innovation in lending at all because all innovation in lending is bad. And between that and the sort of strictures that exist around the way we regulate lending products on a state level and a national level, it forces all of these fintech companies, whether they're good actors or bad actors, to sort of contort themselves into a shape that doesn't make any sense, right? And so like when I look at these direct-to-consumer earned wage access companies, I do have a certain amount of sympathy because it's like, okay, we want to offer a service. We want to offer it in a way that's more financially healthy than a payday loan. And I think to your point, like it is inarguably, and there are some worst case examples, like you said, with tipping and dark patterns and stuff, but generally speaking, it's better than a payday loan. And these customers are going to take out some type of short-term credit product here, better than a lot of the ways people use overdraft protection. They're going to do something here. We're trying to offer an alternative, but they've had to contort themselves to get around being called a lender in such a way where their business model doesn't make any sense, right? And this is my big objection to tipping. Tipping is not only sort of subject to dark patterns and weird behavioral incentives and things you're doing to consumers that I don't like. It's also a bad business model. Like, I haven't heard anyone articulate to me an argument that is both pro-consumer and pro-business for tipping, because either consumers are just, not tipping and are getting this service for free and what a wonderful deal for them, or they're tipping like mad and way over tipping and incurring these massive fees that they don't realize. One of those is good for business, but bad for consumers. And one of those is good for consumers, but bad for business. And all of it relates to, well, the only way we can offer this service and make money without being considered a lender is if we make the fee voluntary in some way. And so whenever I look at EWA, I just don't see that direct-to-consumer model surviving in the way that it's been operating. It just doesn't seem sustainable. To your point, I do think there are ways to package it within a larger set of offerings that do make sense. And I do think earned wage access as a product should exist somewhere because it is a good product and it's better than a lot of the alternatives. So in my mind, you have an employer-based version, and there are employers like Amazon that do this kind of themselves. And obviously Walmart with One, I think, is sort of iterating in these areas. Like, this can either be an employer-based solution where a lot of the costs and the infrastructure or whatever is sort of sits with the employer, or alternatively, I do think this should be a bank product, right? Like, I don't really understand, kind of in the same way that banks are getting into BNPL. I don't understand why banks don't offer this.
A payroll processor product, ADP,
right.
Paychecks,
right.
And I'm pretty sure ADP either has or is working on something in that space. The heat is melting my brain, but it could be a capability that sits, to your point, employer side, bank side, or like payroll processor side.
Yeah, exactly. So to me, this is definitely a feature that sits within a business model that can, to some degree, subsidize the offering of this product in a way that is very consumer friendly and is a nice add-on. It's the direct-to-consumer, this standing by itself, that, well, I'm sympathetic, and I think they've done a lot to push this idea forward and like innovate and show an example in the market. I don't know that I see a real viable business future for a lot of those companies. So that's going to be sort of the challenge here. Mr. Mikula, I'm going to ask you to do just like 60 seconds of nerd talk on the thing we spent yesterday doing. So can you just explain like where we all were yesterday and why?
Yeah, so I was in a car somewhere between Utrecht and wherever I am in France, and we were all tuning in to the much anticipated FDIC open board of directors meeting, which had a number of items, including one on brokered deposits. So just extremely quickly, there was a change in the brokered deposit rule that was finalized in 2020 at a very high level. This was sort of viewed as being friendlier to fintechs, to banks that partner with fintechs, and thus broadly to innovation as far as what deposits are classified as brokered or not brokered. That distinction is important for two main reasons. One, it impacts the deposit insurance assessment, so basically how much banks have to pay to the FDIC, as well as who can use those deposits. So banks that are less than well capitalized either have to get a waiver or are not allowed at all to use brokered deposits. So some changes to the rules in 2020. At the time, someone's name that you might recognize, Yelena McWilliams, was chair of the FDIC, currently the Synapse Chapter 11 trustee. And Martin Gruenberg was a director who objected to this rule change. So it's not terribly surprising that now FDIC chair Gruenberg, alongside CFPB director Chopra and OCC acting comptroller Michael Su,
who also sit on the board of the FDIC, which is unusual and interesting in and of itself, but they're members of the FDIC board. Yep.
Yes, that's the WhatsApp group chat I was referring to.
Right.
Voted together, so 3-2 against the two Republican appointed members to basically functionally reverse that 2020 rule change. And there's a lot of interesting commentary that's worth reading, both in Gruenberg's statement, which is available on the FDIC website, as well as in Hill's statement or a speech he gave maybe when this comes out a couple weeks ago. I think it was at the American Enterprise Institute, sort of discussing brokered deposits. I will say one of the comments that stood out to me from, I forget if it was Travis Hill or McKieran, basically saying this is not the right mechanism to deal with the risks and challenges posed by fintech and partner banking. And I do tend to agree with that. It feels not that this is solely a response to sort of Synapse and some of the other, consent orders. I don't think that is the case, but this is, the whole, and I mean, we all listened to the meeting. It's obscenely complicated minutia about is it a primary purpose exception? Is it more than 10% or 25% of assets? Blah, 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 blah. Very, very sort of specific esoteric rules, and probably not the best way to try to address sort of fintech writ large.
Yeah, I mean, just to add my super duper quick 2 cents on this, to your point, the brokered deposit rules came out of the 1980s. Am I remembering that right? And the idea in the 80s was if you were super rich and had a bunch of money and you just wanted to shop around and get the absolute best rate, you would literally give your money to a broker who would basically just call around using a telephone to all the banks and basically shop your money around to see if they could get the best rate. A lot of these were CDs at the time that were brokered CDs, oh yeah, give us your money, put it in here for a year and we'll give you this rate. So as you might imagine, really hot money, not very sort of stable, not relationship driven. But it was this one very specific mechanism, these brokers, that were the ones driving this shift in the way deposits were moving around the country. And it was being done via telephone. That designation, which has largely remained kind of the way that we still think about it today, with some tweaks and some updates and some rule changes like Jason was mentioning, that's still what we're talking about here fundamentally. And so, before 2020, a lot of this fintech stuff that was happening that was being used to gather deposits was all considered brokered, even though that as a designation didn't really get into the nuances of these different types of deposits and how they would actually behave from a safety and soundness perspective. Then 2020 happens and suddenly none of those deposits are brokered. And, Jason, you've reported on, I think, or written about in your newsletter a little bit, banks having to get in trouble with the FDIC about misclassifying certain sets of deposits that they had. But suddenly most deposits weren't brokered. They're all non-brokered deposits. Well, okay, yes, but still there's probably some nuances we're missing here. And now that, the winds have shifted again, now we're reversing that guidance. And now, I mean, this is my just sort of very stupid high level take. All deposits are going to be considered brokered again under this sort of revised rule or the repeal of the old rule. Again, it's not really telling us anything nuanced or interesting or useful about the nature of these deposits. We just keep flipping between brokered and non-brokered. And so, channeling my inner Kia Hazlitt for a moment, give us the data that you guys have been observing about how these deposits actually behave, write up a report, publish that report, share the data with us. And then, to your point, come up with a regime and a structure and a framework here that actually more accurately classifies all these different types of deposits and how they should be treated from a risk perspective. So I guess that's our plea. I suppose we're channeling the Republicans on the board a bit when we're talking about this, but I do think that's my core frustration with this. And just to put a fine point on it, I was exchanging messages with a fintech founder who has a business model and a product that does generate deposits for partner banks. And their kind of quick take on it was, not having analyzed the nuances a lot yet, this is going to make it harder for me to get a partner bank and to negotiate with partner banks, because my deposits that I'm giving them are now being treated in a much more punitive way. Likely,
well, they're literally less valuable economically. So
right.
It makes it less attractive to use that as a funding source versus doing something else.
Yeah, exactly. I mean, like, the leverage continues to move away from fintech companies. And I think, again, everything being a chapter in the multiverse of banking as a service stories that we've been covering, it's just harder to get a bank partner now for a lot of different reasons. All right, Jason, before I let you go, we've been doing this for a while now, so I'll just make this super quick. Do you have a can't let it go for me?
Yeah, I mean, speaking of telephones, and actually it was in the same, I think, Travis Hill speech, I did not realize, I guess this shouldn't be too surprising, that if you're a bank and you're like, hey, oh man, I need some emergency liquidity, the way you do that is by literally calling up the Federal Reserve discount window on the telephone, which I guess, given that the discount window is named for a physical window, it shouldn't be too surprising that the way you do this is by like calling up your friendly discount window operator at your reserve bank, whatever district you're in.
Yeah.
I read that line and I'm like, really? Like this, it's 2024 and this is how this works? So yes, that is what I can't let go of from the last time we spoke.
And an amazing detail. It's relevant too, because, when you sort of deconstruct what happened with like Silicon Valley Bank, a big part of it was the mechanics of being able to get that emergency funding when they needed it. So yeah, maybe telephone, not the best idea.
And in time zones, right? I mean, California to DC.
Right. Yeah, like, sorry, they've gone home for the weekend. There's nothing we can do. Like, what do you mean there's nothing we can do? This is insane. No, it's absolute.
What can you not let go of?
Well, so mine is crypto, because I can't help myself. But you've probably seen the whole sort of story that's being put out there that there's a large pro-crypto voting bloc that's going to vote in this election, Jason. And they are out there in swing states. These are real people, and crypto is the only agenda item they care about, or it's their top policy. Like, they might disagree with all your other positions, but if you are pro-crypto, you will get their vote. And they don't like Gary Gensler. And on day one, whoever's in charge come, 2025, like, they better fire Gary Gensler, whether they're legally allowed to or not to, because God damn it, like, I need pro-crypto policy. These voters are out there and they will swing this election. And if you don't take them seriously, you do so at your peril, Mr. Mikula. That story's fine. And I understand why you want to sort of tie that story to all the money that you're pouring into all of these races, sometimes perhaps in violation of federal law. However, no one has been able, and if you listen to this and you have this, please share it with me. No one has been able to give me actual data, unbiased, real, good, well-sampled data that suggests that these voters are actually a real thing in large numbers. And I just can't let this go. It's driving me crazy.
Outside of a handful of like crypto millionaire, billionaire types, and I suppose also the Andreessen guys, given some of their recent podcasts. I'll stop. Let's just
no. It's what it is. I mean, unless it's the population of people who went to the Bitcoin conference in Nashville, that group, I believe, is the voting bloc we're talking about. If there's anyone outside that group that cares about this, and like, I'm a crypto holder, I have crypto, I suppose, in a general sense. I want it to go up. My Crypto Coven NFT that I still own, that I think its value has crashed through the floor and into the basement and the sub basement. I'd love to see her value go back up. Like, I'm pro crypto, I guess, in that sense, but it is far from the top of my list of policies that I care about in this election, and I think I'm not alone in that respect.
I think that's a good place to put a pin in it until next month.
I think so too. Before we get ourselves into too much trouble, Jason, a delight as always. We will see you next month, sir.
Can't wait.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.